Whenever it comes to the context of trading, it is often considered to be very complex the majority of the time. However, in reality, it is nothing like that. Everything you need is to do some calculation using your intelligence. You will come across all the essential aspects of options trading in this book. People often think of options as exotic and risky. In fact, some people have the notion that people with great bank balances can only invest in the same. In actuality, all of these are wrong. We will discuss all types of questions in this guidebook and every aspect of options trading that you will need to get started. It does not actually matter the kind of investor you are. Trading of options might turn out to be a great source of income for all of us. It comes with the benefit of providing great profits besides leveling up your portfolio structure. It might be the case that you have decided to start low. You can enhance the same gradually with options. If there is any kind of market downturn, options can also act as an insurance shield for you. After you get done with this book, you will surely get the feeling that you know everything about options and get yourself ready for the world of trading. There are plenty of books that you can find on this subject on the market. Thanks once again for opting for this one. Every effort was made to make sure it is enriched with as much useful information as possible. Please enjoy. Chapter 1. Starting with options trading. Options come with flexibility for all types of investors at each and every level, and also provide them with the needed help to manage all types of risks. In order to determine whether options can be placed in your portfolio, have a look at the basics of options first, why investors opt for them, and also how to get started. What are options? An option is like a contract of selling or buying a stock, generally 100 shares of the stock every contract, that comes with a predetermined price and a fixed date of expiration. Similar to buying stocks, as you think the price might go up or short any stock when you get the notion that the price might drop, options permit you to bet on the direction that you think the stock price might move. However, in place of shorting or buying the asset directly, as you buy an option, you will be buying a contract that will permit you to do various things, like sell out the contract to some other investor, sell or buy shares of the stock at some agreed upon rate, known as the strike price, for a limited time period, allow the contract to expire and just walk away without any kind of future financial obligation regarding the same. Options trading might sound like it is only meant for the ones who can commit, and it might work only if you are looking for capitalizing on price movements of short-term and also trade out and in of contracts. However, options can be put into use for buy and hold investors for the long term as well. Why opt for options trading? Investors put into use various options for various reasons. However, the primary advantages of options trading are: buying any option needs a much smaller initial outlay when compared to purchasing the stock. An options contract can provide protection to the investors from any kind of downside risk simply by locking in the price without any kind of further obligation to purchase. An options contract buys time for an investor to determine how things might play out. In case there is some company that you have had your eyes on and you believe that the stock price will surely move up, a call option will give you all the right, but no obligations to purchase shares at a predetermined price at some later date. In case your predictions tend to pan out, you will get the chance to purchase the stock at less than it is actually selling for the open market. In case it does not, your overall financial losses will only be limited to the contract's price. You will also get the chance to limit your risk exposure on the stock positions that you have already. Suppose you have the possession of stocks in a company. However, you are worried about the short-term volatility that might wipe out all your gains from the investment. For hedging all the losses, you can purchase a put option that will provide you all the right for selling out a fixed number of shares at some predetermined rate. In case the price of the shares moves downward, the option will be limiting all your losses. All your gains from selling will help in offsetting some portions of the financial injury. Trading option in 4 easy steps. Options trading might seem a bit complex for some people, a bit more than trading of stocks. As you buy a stock, you only need to make up your mind the number of shares you want, and your desired broker will fill the order at the already existing market price or a set limit price from your side. Options trading needs some understanding of certain advanced strategies. The process of opening an account for options trading needs some more steps than opening up any typical account of investment. Here is everything that you need to know to get started with options trading. Learning the needs for account opening. Right before you can get into trading of options, you will have to provide some proof that you know everything that you are going to do. In comparison to opening any kind of brokerage account for trading stocks, opening an account for options trading needs more amount of capital. Provided the great complexity of predicting several moving parts, brokers require to get some more idea about any potential investor right before awarding him or her with a slip of permission for starting options trading. The brokerage firms tend to screen the potential traders of options for assessing their experience of trading, their financial preparedness, and their overall understanding of the associated risks. You will have to provide your prospective broker with objectives of investment. It might include growth, income, speculation, or capital preservation. Experience of trading. The broker will want to have some idea about your investing knowledge, the time frame for which you have been trading options or stocks, the number of trades that you make every year, and also the overall size of all your trades. Information regarding personal finances. You will need to let the broker know your total net worth, available liquid net worth, yearly income, and also information regarding your employment. The options types that you are willing to trade. You will have to let your broker know the types of options that you are willing to lay your hands on. Based on all your answers, your broker will assign you a starting level of trading that will act as the key to placing some types of options trades. Also, screening needs to be done both ways. The broker that you opt for trading options will act as an essential investing partner. Finding the proper broker that can offer you with research, tools, support, and guidance that you need is very important for all those investors who are completely new to the world of options trading. We will discuss how to choose your broker in the latter chapters. Deciding which direction you think any related stock might move. It will help in determining the type of options contract that you opt for. In case you think that the price of a certain stock will move in the upward direction, you will have to purchase a call option. In case you think that the stock price will decline, you will purchase a put option. Refreshing it up, a call option provides you the right, however, not any kind of obligation to buy a stock at the fixed strike price by a fixed time period. A put options contract will provide you the right, however, not any kind of obligation to sell the shares at the strike price prior to the expiration of the contract. We will discuss calls and puts in detail in the upcoming chapters. Predicting how low or high the price of the stock might move. Any options contract will remain valuable only when stock price gets closer to the expiration period of the option, quote unquote, in the money. It means either below or above the strike price. For call options, it will be above the strike price, and for put options, it will be below the strike price. You will want to purchase an option with some strike price that tends to reflect where exactly you predict the stock will be right during the lifetime of the option. For instance, if you feel that the share price of some company that is trading currently for $120 will rise to $140 within some time, you will buy a call option contract at a strike price which is less than $140, ideally. Some strike price which is not more than $140 minus the option's cost, so that your option can be profitable at $140. In case the stock price indeed goes beyond the predetermined strike price, your option will be in the money. Similarly, if you have the belief that the share price of the company is going to move below $100, you will buy a put option contract that comes with a strike price of above $100. Ideally, any strike price that is not below $100 plus the option's cost, so that your option stays profitable at $100. In case the stock price goes below the strike price, your contract of option will be in the money. You cannot just choose any strike price that you feel like. Options quotes, also known as option chains, comes with a certain range of available strike prices. The overall increments available between the strike prices are properly standardized all across the industry. For instance, $2.50, $5, $10, and are also dependent on the stock price. The price that needs to be paid for an option, known as the premium, comes with two components: intrinsic value and time value. Intrinsic value is the overall difference between the share price and the strike price. Time value is whatever is remaining and also factors in the stock volatility, the time left before the date of expiration, and the rates of interest, among several other elements. For instance, suppose you own a call option for $110 where the stock costs $120. Let us assume that the premium of the option is $15. Then the intrinsic value will be $10, $120 minus $110, and the time value will be $5. It will lead you to the final choice that you will have to make right before purchasing an options contract. Determining the time frame within which the stock is most likely to make some movement. Every options contract comes along with a date of expiration that helps in indicating the last day within which you can exercise the related option. Here, also, you just cannot pull a date out of thin air. The choices are limited to the ones that you get offered at the time of calling up an option chain. The expiration date can easily range from some days to certain months or even years. Regular and weekly options come with the maximum amount of risks and are generally reserved for the seasoned traders of options. For long-term investors, yearly and monthly dates of expiration are mostly preferred. Having longer expiration dates will provide the stock with more time to move and also time for all your thesis of investments to properly play out. A longer expiration date also tends to be useful as the option can easily retain the time value, even when the stock tends to trade much below the determined strike price. An option's time value will keep decaying as the date of expiration approaches. Also, the buyers of options would not want to watch all their purchased options decline in overall value, expiring worthless in case the stock tends to finish much below the strike price. In case a trade goes against them, they can still sell out any of the time value that is remaining on the related option, and it is more likely to happen when the contract of option is longer. Chapter 2: Calls and Puts. When it comes to options, there are two types of the same available for you: calls and puts. Options of the American style come with the benefit of getting exercised during any time right before the expiration date. On the other hand, options of European style can only be exercised on the date of expiration. For entering any option contract, you will have to pay an option premium. Call options. It gives the right to the buyer, however, not the obligation, to buy an underlying security right at the strike price that is mentioned in the contract of options. Investors opt for purchasing calls when they think that the underlying asset's price is going to rise, and sell out call options when they think the underlying asset's price is going to decrease. Put options. It provides the buyer with the right, however, not any kind of obligation, to sell out any underlying security at a mentioned strike price. The seller of put options will have to buy the underlying security in case the buyer decides to exercise their options. Investors purchase put options when they believe the underlying asset's price is going to move downwards, and sell out put options if they think it will move up. Options payoffs. Let's have a look at the various payoffs of options. Calls. The buyer of any call option will pay the premium of the option in full while entering the contract. After that, the buyer would enjoy some potential profit when the market tends to move in his favor. Well, there is no other chance of the option developing any further loss beyond the mark of the purchase price. It can be regarded as one of the attractive features of purchasing options. With a limited investment, a buyer can secure a potential of unlimited profit with a limited and known potential loss. In case the spot price of any underlying asset does not tend to move beyond the option strike price before the expiration, the investor will lose the amount paid for that option. But in case the underlying asset's price tends to move beyond the strike price, the purchaser of a call option can make a profit. The profit amount can be regarded as the difference between the market price and the option strike price, multiplied by the overall incremental value of underlying assets subtracted by the option's cost price. For instance, a stock option is about 100 shares of the underlying asset. Suppose a trader purchases a call option contract on XYZ stock at a strike price of $25. The trader pays out $150 for the option. On the date of expiration of the option, the stocks of XYZ are selling at $35. The option's buyer exercises the right to purchase 100 XYZ shares at $25 for each share, which is the option strike price. The trader sells out his shares at the present price of the market of $35 each share. The trader paid out $25 by 100 shares, which equals $2,500, and sells out his shares at $35 by 100 shares, equaling $3,500. He makes a profit of $3,500 minus $2,500, which equals $1,000, minus the paid option premium, which is $150. So the net profit would be $1,000 minus $150, which equals $850. It can be regarded as a great return on investment of only $150. Selling calls. The downsides of the seller of a call option are actually unlimited. As the underlying asset's spot price tends to excess the strike price, the seller of the option will incur a loss. But if the price of the market of the underlying asset does not tend to move ahead of the contract strike price, the option expires worthlessly. The seller of the option will make a profit in the premium amount that they received for the related option. Puts. A put option will provide the buyer all the right to write the underlying assets at the predetermined strike price of the option. The profit that the buyer will make on the option relies on the extent to which the spot price tends to go below the strike price. In case the spot price goes below the strike price, the purchaser of the put option will be in the money. In case the price stays higher than the strike price, the option will then just expire unexercised. The loss of the buyer, again, will only be limited to the paid amount of the premium. The writer of the put option will be out of the money in case the spot price of the underlying security goes below the contract strike price. The loss will be equal to the profit of the buyer of the option. In case the spot price stays above the strike price, the option will just expire unexercised. The seller will pocket the premium of the option. Application of options. Options, both calls and puts, are used by the investors for hedging against the risks in the existing environments. It frequently happens, for instance, that any investor who owns some stocks sells or purchases options on the stock in order to hedge the direct investments in the underlying asset. The options investments of the investor are designed in a way to partially compensate for any kind of loss that might be incurred in the underlying assets. But you can also use options as speculative investments. Buying puts. Hedging. In case an investor thinks that some of the stocks that they have in their portfolio might just drop in price, however, they do not want to abandon the position of the long term, they can opt for purchasing put options on that stock. If the stock goes down, the put profits will be offsetting actual losses in the stock. Generally, investors tend to implement such strategies when there are some periods of uncertainty, like the earnings season. They might purchase put options on certain stocks that they have in their portfolio or purchase index puts for protecting their well-diversified nature of the portfolio. The managers of mutual funds often use puts for limiting the downside risk exposure of the fund. Purchase calls or sell puts. Speculation. In case an investor thinks that the price of underlying security is most likely to rise, they can sell puts or purchase calls for benefiting from the price rise. In purchasing call options, the overall risk of the investor is only limited to the paid premium for the related option. The potential profit is actually unlimited. It can be determined by the extent to which the market price tends to exceed the contract strike price and the number of options that the investor holds. For the seller of puts, the things get reversed. The potential profit is of limited nature to the premium that they receive for selling the put. The potential loss is actually unlimited, which is equal to the amount by which the spot price is below the contract strike price, multiplied by the total number of sold options. Purchase puts or sell calls on bearish securities. Investors can easily benefit from the downward movements of price by either purchasing puts or selling calls. The upside to the call seller is only limited to the premium of the option. The put buyer might face unlimited upsides. However, it has a very limited downside, which is equal to the price of the option. In case the underlying asset's market price falls down, the buyer of puts will make profits to the extent the market price goes below the contract strike price out. If the hunch of the investor was wrong and the prices do not go down, he will only lose the premium of the option. Options and its styles. The majority of the options that you will buy will fall under either of the categories: European options or American options. Both the options are often called vanilla options. American options. In this style of option, the investor will get the opportunity to exercise all the options at any time right before reaching the date of expiration. Most of the options on equity as well as on stocks fall under this category. You can trade all such contracts for future exchanges. European options. Options of this style can be exercised only on the date of expiration that has been mentioned in the contract of options. They are generally traded over the counter. Chapter 3. Having the right mindset. In case you do not possess the right mindset of trading, you will surely fail. It can be considered as an essential thing that some possess as a trader. The mindset of trading is something that you are required to start with even before you learn some effective strategies of trading. What is mindset? It is the established set of beliefs and attitudes that is held by a person. The trading market does not care about any of your thoughts or beliefs. Well, having the winning trading mindset can be regarded as the only way. Successful trading is quite hard, and developing the proper beliefs and attitudes is the only way that can develop the skills and habits required for some profitable trading. The overall reason is quite simple. There will always be resistance in front of success, no matter what you do, and the same goes for trading as well. Only those who come with the right mindset can rise to the top. No form of emotion can work in the trading market. So, all of it will depend on how you are going to perceive the entire market. When your goal is to maintain the status of a successful trader for the long term, you will have to frame the perfect mindset. It will provide you with all the help that you will need for seeing the market from a viewpoint where no emotion exists. The nature of the mindset with which you will get into the market will define all your reactions as you make some profits or lose some great amount. Successful traders will never let their emotions get into their decisions of trading. You can achieve the same as well. No matter the field of life you are presently in, Having the correct mindset can provide you with all the tools that you will need for attaining all your desires and goals. Identifying the right beliefs and attitudes. Here is a list of all those things that you might find useful while developing the right trading mindset. Commitment. No matter what kind of task you opt for, you are required to commit to the same right before you start. You will have to make sure that you do not quit no matter what happens, and that you will do anything that is required for accomplishing your goals. All of this also includes developing and working on your mindset and not only your skills of trading. Persistence. Being a successful trader and maintaining the same is never going to be easy. You will need to be all set up for ups and downs and just let yourself keep moving ahead and improve regardless of all the difficult times. Self-awareness. Self-examination is important for developing the winning mindset of a successful trader. The proper ways of doing so are not by being critical, emotional, or judgmental when you find things wrong, but by creating a plan of action for building out and enhancing all your weaknesses. Positive attitude. Having a positive attitude is not about denying the truth simply by saying that everything is perfect no matter what is the actual case. It is all about staying positive when something wrong happens and giving your all to fix the same. For instance, you will say, "Yes, I failed to follow the rules this week. However, I am confident of doing better the next week." The exact opposite of this is having a negative attitude where people will try to determine and attach blame for all their problems. Attaching blame would prevent you from doing all those things that you will need for developing self-growth. Performance metrics. You will have to develop a list of performance metrics that will include all your goals to showcase whether you are actually growing or not. You will need to analyze all the results related to your goals on a daily basis. Try to keep yourself accountable for analyzing all the results. It is exactly where persistence comes into the picture. Be persistent in analyzing all your performance metrics and implementing brand new ways to improve. Hunger. It is not the hunger for achievement, but the hunger for growth. Having the hunger of a growth mindset will help in keeping you on the road to consistent improvement as long as you are growing as a person, as a whole, and as a trader to see financial improvements follow. Openness. It is quite hard to share all your faults openly, specifically for all those who lead other people. In case you are willing to share all your struggles and simply reach out for help, it will help at keeping you growing. Some of the greatest times of development come from some of the most dreadful circumstances. All of us go through the same, and so we need to be ready for all of them and easily share them. Humility. A person who comes with a winning mindset of trading cannot be better than someone else or even smarter than others. You will need to understand that the road of growth is challenging, and you are needed to stay humble and just keep learning. Failing to do so will result in a decline. The battle is in the mind. Having the right trading mindset alone can do nothing for improving your overall trading results. You will have to combine the perfect mindset with all your actions for the best results. It is often heard that people saying having a positive attitude is all you need, and you will be great. However, it is not true in actuality. The truth is that the correct mindset acts as the growth catalyst. When you do not have the required mindset, you will not be able to opt for the growth journey as a successful trader. The first thing that comes to the list is your attitude, followed by all the actions. Then comes the results, and then the cycle keeps going. Mindset, action, result. You can regard this as the growth cycle of traders. Getting started. Try to have a look at the above-mentioned list once more, and then have a look at your own self. Try to develop a questionnaire and write the same down on a journal or a piece of paper. Ask yourself, am I committed to the process of trading along with the development of my trading mindset? You will have to write down all those things that come to your mind regarding your commitment level. Keep going down the above mentioned list and write down the answers to each of the questions. It can be regarded as the initiation of self-awareness for many people who are reading this guidebook. There is nothing to hurry about. Take the time you need and try to go as deep as you can for a proper understanding of a trader's mindset. When you try to be honest with yourself, you will be able to find out several areas that you can improve. It is the very first step in developing the mindset of a successful trader and also attaining all your goals. After you are done with this part, you can then start working on all your tactics and strategies. However, it is true that the real battle is in your mind, and if you are not able to win that battle, why try to be successful in the market of trading? The mindset will always come first, and then only you can start working on your skills, tools, and strategies. The mindset will always be there and will be something all the time that any successful trader will be working with. Never stop learning. One of the primary things that the majority of successful traders opt for improving their trading mindset is to develop a great knowledge base. Enhancement of your knowledge regarding how the trading world actually works will help you in making much better decisions, both in the long term and short term. Getting every kind of knowledge regarding how trading actually works will help you react in a calm way to the several curveballs that you will need to cross in your path of trading. Try to think in this way. You would never try to opt for a huge plumbing repair without knowing all those things that might go wrong and all those things that are involved with the overall job. You will have to opt for some research in order to make yourself ready for all kinds of possible outcomes. In the same way, successful traders try to educate themselves as much as possible to opt for more informed decisions and also minimize the overall risk. One of the best ways of educating yourself is by being with all those professionals who actually understand the functioning of the market. The strategies and skills that you will learn from them might provide you with some great help. Also, successful traders can change their view on the probable movements of prices in the future without trying to give it a number of thoughts when the market indicates to do so. Chapter 4. Common mistakes in options trading. As entering the world of options trading as a newbie, it is a common thing to start feeling overwhelmed. One of the primary benefits of options trading is that it will provide you with several ways of taking advantage of your belief of what might happen to the underlying asset. However, one of the downsides of trading such luxury varieties is the increased risk of making mistakes. The aim of this chapter is to make you aware of some of the common mistakes of options trading so that you can make wiser decisions for making some profits. Strategy mismatches with the outlook. An essential component while starting to trade options is the capability of developing an outlook for all those things that you believe might happen. Two of the most common points of starting to develop an outlook are opting for fundamental analysis and technical analysis, or both. Technical analysis is all about interpreting the action of the market on a chart and determining areas of support, trends, or resistance for identifying the potential sell or buy opportunities. Fundamental analysis is about reviewing the financial statements and performance data of a company, along with the present trends of business, for formulating a proper outlook of the value of the company. An outlook will not only contain directional bias, however, it also encompasses a time frame as to how long a trader believes their idea will take to properly work. As you keep reviewing various strategies of options, it is essential to ensure that the chosen strategy is designed in a way for taking full advantage of the expected outlook. Choosing incorrect expiration. As with strategies, you will face some issues with the various choices when it comes to deciding the date of expiration. Well, the good news is that in case you establish an outlook, then the selection of a proper expiration date easily falls into place. One of the ways of opting for the best date of expiration is by having a checklist. How long, according to you, will it take for the trading to play out? Do you want to hold a trade through any stock split, earnings announcement, or any other event? Is there enough liquidity available for supporting the trade? Opting for the incorrect position size. Most of the errors of position sizing tend to develop from two emotions, greed or fear. In case you tend to be greedy at the time of making decisions, you might just end up trading a position size that is way too large than the actual size of the account. It might take place when any trade goes right against the outlook and you get stuck with a huge loss. On the contrary, you might opt for trading extremely small. Trading on small size is okay. However, you might also miss out on certain material returns. Some of the common ways of position sizing are risking a percentage of the account value, 2%, 3%, 4%, etc. Or using a consistent value, $500, $100, etc. While deciding the size of the trade, you will have to be comfortable with the capital amount that you might lose in case the trade goes against you. Not paying attention to volatility. Implied volatility is the measure of what the trading market expects volatility to be for a given security in the future. It is essential to recognize if the implied volatility is low or high, as it helps in the determination of the option premium. Knowing properly whether the premium is cheap or expensive is an essential factor while deciding on the option strategy that make the most sense for the outlook. In case the options are quite cheap, it will be better to have a look at the debit strategies. And if the options are expensive, you might be better served if you look for the credit strategies. Not putting probability to use. Considering the probabilities of the strategies is an essential factor that comes into play while making decisions to place any trade. Not only will it provide you with a perspective regarding what is most likely to happen statistically, but it will also make you aware of the reward or risk. It is essential to keep in mind that probability does not come with any directional bias. It is nothing more than the statistical chances of a price being at any specific level on the date of the evaluation, provided the present factors. Not having a plan of trading. One of the primary steps of getting into the world of trading is to have a proper trading plan. Any kind of basic trading plan should include the time when you will enter the trade, the amount that you are willing to risk for each trade, your strategy of exit, and the way you will find new opportunities in the market. As already mentioned earlier, greed and fear can easily result in irrational decisions that you shouldn't make normally. The primary benefit of possessing a trading plan is to discard all sorts of emotional feelings from trading. It also helps in the creation of a process that is repeatable easily. Repeatability is a very important factor that can help you learn from all your mistakes and also have the capability to see all the flaws in those trades placed by you. Without the presence of a proper plan, it might turn out to be quite difficult for you to improve as a trader and move ahead. Misunderstanding leverage. The majority of beginner traders tend to misuse the leverage factors that get offered by the option contract. They fail to realize the amount of risk that they are taking. Often, they get drawn to purchasing short-term calls. You will have to master leverage. One of the general rules for beginning with options, in case you usually trade 100-share lots, then try to stick to one option to begin with. In case you usually trade 300-share lots, then it might be 3 contracts. It is a great test amount to begin with. If you fail to succeed in these small sizes, then you are most likely not going to succeed with the trades of a bigger size. Not being open to brand new strategies. A great number of options traders often say that they would never purchase out of the money options contracts or would never write in the money options. Well, all of this seems absolutely silly, until you can find yourself in any trade that has moved against you. You will have to be open to new strategies of options trading. Keep in mind, options are derivatives, which indicate all their prices would not move in the same way or even possess the same kind of properties as the underlying stock. Time decay, no matter bad or good for the position, always has to be factored in the plans. When things tend to change in the trade, and you are reviewing the earlier unthinkable, try to take a step back and question yourself. Is this the move that I would have opted for when I opened the position for the first time? If your answer is no, do not opt for it. Close your trade, cut the losses, or just look for new opportunities that can make sense now. Options tend to offer great possibilities for leverage even on low capital. However, they might blow up quickly as any other position in case you keep digging deeper. Try to opt for a small loss when it gives you the chance to avoid a disaster later. Trading illiquid options. Liquidity is nothing but how fast any trader can sell or buy something without resulting in any kind of significant movement in price. A liquid market is one that is ready with active buyers and sellers all the time. Here is another way of thinking about the same. Liquidity also refers to the probability that the upcoming trade is going to be executed at an equal price to the last one. Stock markets tend to be more liquid in comparison to the market of options for a very simple reason. The traders of stock are just trading one stock, while the traders of options might have to deal with several contracts of options to select from. For instance, the traders of stocks will only flock to one form, like IBM stock. However, options traders can have 5 different expirations along with various strike prices to select from. More number of choices indicates that the market of options will not be as liquid as the market of stocks. Opting for illiquid options will drive up the overall cost of doing business, and the cost of options trading are higher already on the basis of percentage in comparison to stocks. So, there is no need to burden yourself. In case you are opting for options, ensure that the open interest is a minimum of equal to 40 times the number of contracts that you are willing to trade. Waiting for a long time to purchase back short options. Well, this mistake can be centered down to a single piece of advice. Be ready and willing to purchase back short options as early as possible. Traders tend to wait for a long time to buy back the options that they have sold out. There are various reasons why. For instance, you tend to bet that the contract will just expire without any worth. You are not willing to pay the commission, or you are hoping to take out only a small portion of the profit from the trade. You will need to be aware of when to purchase back the short options. In case your short options tend to get way out of the money, you can purchase it back for taking the risk off the table in a profitable way. Just do it. There is no use in being cheap. For instance, you sold out an option of $1, and now it is worth 20 cents. You would just not sell out an option of 20 cents to start with, as it would not be worth the same. In the same way, you should just not think it is worth it to take the last remaining cents out of the trade. If you are able to keep about 80% or even more of the initial gain from the sale of an option, you should always consider purchasing it back. Chapter 5. Options Trading Strategies. Most traders tend to jump into the market of options trading without having any form of knowledge of the options trading strategies that are readily open for them. You can find several strategies of options that can easily maximize the return besides limiting the risk. With only a bit of focus, traders can easily gather knowledge regarding the ways in which they can take full benefit of the power along with the flexibility that options can offer. Let us have a look at some of the basic strategies of options trading that can be useful for any beginner trader. Covered call. With call options contracts, the best strategy is purchasing a naked call option. Also, you can easily develop a basic covered call or buy right. It is a famous strategy as it helps in the generation of income and also cuts off some of the risks of being long alone on any stock. The only thing is that you will have to write the shares at a fixed price, which is also termed short strike price. For proper execution of this strategy, a trader will have to buy the underlying asset as you would have normally done and also write a call options contract on similar shares. For instance, an investor uses a call options contract on any stock that represents 100 stock shares every call option. For every 100 stock shares that the related investor buys, he will have to write one call options contract against the same. The strategy is termed covered call, as in any event that the stock price goes up quickly, the short call of the investor will be covered with the position of the long stock. The majority of investors might opt for the same strategy when they tend to have a short-term position in stock along with any neutral opinion on the same direction. Such investors might look forward to generating profit using the premium sale or just get protection against any form of fall in the value of the underlying asset. Married put. In this strategy, you will purchase an asset, like stock shares, and also purchase contracts of put options for the same share numbers. A put option holder comes with the right to write the stock at the predetermined strike price, where each of the contracts is worth 100 shares. Any investor might opt for the strategy of married put as a superb choice of protecting themselves against the disadvantaged risk of holding back on stock. Well, the strategy tends to function just like a policy of insurance. It tends to establish a price marking in any situation when the price of the stock declines sharply. For instance, an investor purchases 100 stock shares besides buying a contract of put option at the same time. The strategy of married put might seem quite appealing for the investor, as they will get protection against the downside in any event if the stock price changes negatively. At the same time, he would get the chance to take part in every opportunity of upside nature when the stock rises in value. The only downside that comes with the strategy of the married put is that in the case the price of the stock fails to decline in value, the related investor would lose all the paid premium for the put option. Bear put spread. It is a type of vertical spread. An investor using this approach will buy out options contracts at a certain strike price besides writing the exact number of put options at a strike price lower than the first one. The options contracts are bought for the same asset besides having the same expiration date. The strategy is used when a trader comes with bearish sentiment regarding the underlying securities besides expecting the price of the security to go down. In this strategy, a trader can have limited gains and limited losses as well. Bull call spread. In this approach, an investor purchases call options at a fixed strike price besides selling out the exact number of calls at a greater strike price. Two of the call options contracts will bear the ditto underlying asset and expiration date. A vertical spread strategy of this nature is put into use when a related investor is bullish on an underlying security besides expecting some degree of rising in the asset price. With the help of the strategy of a bull call spread, an investor can easily cap the upside of their trades besides reducing the total spent premium. Protective collar. In this strategy, a trader will have to purchase an OTM, out of the money, put option besides selling a call option that is out of the money. Also, the date of expiration and underlying security has to be the same. The strategy of a protective collar is put into use by traders after experiencing substantial gains in any long position in a stock. It permits investors to get protection from the downside because the long put provides needed help in locking in the potential price of a sale. But the deal is that they need to write the shares at a much greater price, thus opening up all the chances for more gains. For instance, if you are long on 100 shares of ABC, priced $50 for each, and ABC moves up to $100 by the 1st of January, you can easily develop a protective collar by purchasing an ABC March 95 put besides selling out on ABC March 105 call. You will get protected under the mark of $95 right until the date of expiration. The deal here is that you will have to write the shares at a rate of $105 in case ABC trades at the same rate before the date of expiration. Long straddle. In this strategy, an investor will have to buy a call options contract along with a put options contract at the same time, and also on the ditto asset with the same strike price and expiration date. Investors often put into use such a strategy when they are sure the underlying asset's price will cross a particular limit. However, they are unsure of the direction that it might take. Such an approach permits investors to attain the chance of unlimited profits. Also, the maximum amount of loss that might be experienced by an investor is restricted to the two options contracts cost summed up. Long strangle. For using this strategy, an investor needs to buy a call option that is out of the money, along with a put option which is out of the money on the ditto asset and the same date of expiration. Investors who opt for this approach believe that the underlying asset's price might experience a great movement. However, they are not sure of the direction it might take. The overall losses are restricted to the spent premium of the two options. One thing that you need to keep in mind is that strangles are always cheaper than straddles, as the purchased options are OTM options. Long call butterfly spread. In this strategy using call options, a trader will need to combine a bear put strategy along with a strategy of bull spread. Also, for this, 3 types of strike prices will be used. All of the options will be for the same security with the same expiration date. For instance, this strategy can be developed by buying a call option that is in the money at a lesser strike price, besides writing out 2 call options that are at the money and also purchasing a call option that is out of the money. A spread of balanced nature will possess the same widths of wings. The case mentioned here is known as call fly. It develops total debit. Investors opt for strategy when they believe that the stock might not move much before the date of expiration. Iron condor. For this strategy, an investment will hold a bear call spread along with a bull put spread. An iron condor gets developed as you purchase an OTM put and sell an OTM put option that comes with a lower strike price. One bull put spread and purchasing an OTM call option and writing an OTM call option of a greater strike price. One bear call spread. The options contracts need to have the same expiration date while having the same underlying security. Generally, the side of the call, along with the put, comes with the same width of spread. In this approach, an investor can earn a premium from the overall structure. The approach is also developed in a way that can help in taking full advantage of any stock that is going through low volatility. Most traders opt for this approach because of the anticipated high probability of getting a narrow premium amount. Iron butterfly. For this approach, you will have to write a put option that is at the money, besides buying a put option that is out of the money. They will also have to purchase a call option that is out of the money and sell out a call option that is at the money. The options will come with the same expiration date while being on the same underlying security. Though the overall approach is more or less like the butterfly spread, it puts into use puts and calls together. Chapter 6. How to choose a broker. Profitable investing needs you to opt for a brokerage service that properly aligns with all your educational needs, investing goals, and also the style of learning. Specifically, for all the new investors, selecting the best possible broker that properly fits with their needs can actually mean the difference between a frustrating disappointment and a new stream of income. Although there is nothing that can guarantee you investment returns, there is a great way to set yourself up for success by opting for an online broker that suits all your needs. We will break down all the essential and basic things that you need to look out for in an ideal brokerage in this chapter. Knowing all your needs. Right before you click on any brokerage site or platform, try to take some moment to figure out What are the most important things for you in a platform of trading? Well, the answers will vary for each one of us as it will depend on the goals of investment and your position in the learning curve of investment. In case you are a newbie and you are just starting out, you might want to prioritize basic features like educational resources, easy access to support, comprehensive glossaries, and also the ability to opt for practice trades right before you can start investing your real money. If you have got some experience in investments and you are thinking of being serious with the same, you might want to opt for a higher level of education besides opinion-based resources that are authored by expert analysts and investors, along with a great selection of technical and fundamental data. Try to be honest with yourself regarding your position in the journey of investment and the destination that you actually want to reach. Are you searching for establishing a retirement fund or just focus on passive investments? Do you want to tailor your own portfolio or just take the help of a professional for doing the same? Relying on the path that you want to opt for, you will have to consider several questions on your own that will help in the refinement of all your goals. Fees and commissions. It is quite logical that one of the essential considerations while choosing a broker is to determine the charges. Generally, charges can be broken down into two primary categories: fees and commissions. Commissions are charges on the transactions that you opt for, whether you are selling or purchasing options. So, it can be easily understood that the commission might sum up to a great sum in case you are opting for a lot of transactions. There are brokers that come with a minimum commission, and it is something that you will have to look out for in case you are making up your mind to opt for a certain number of small trades. Also, there are brokers that might charge higher commissions relying on the type of option that you are transacting. The fees might consist of various types of charges that will also include an annual fee for maintaining an account, charges for withdrawals and deposits, or extra charges for making some types of orders. Relying on the styles and strategies of trading that you are using, you might be opting for trades that will develop profits that are quite small in comparison to the total invested amount. It is quite common for traders of options to operate on tight margins, and all of this makes it quite essential to cut down the costs that are involved with the making of trades. Even when you decide to opt for trades that come with higher margins, there is still a definite benefit of reducing the costs. Lower the costs means more profit. One of the primary costs that are involved with options trading is, of course, the fees and commissions that are incurred at the time of making transactions. So, right before you sign up for any broker, you will have to be aware of the commission structure along with any kind of additional fees that might be applied. All of this will help you to be sure of the charges and whether they are suitable for your way of trading. But you will also need to note that fees and commissions are not the end of it. They are obviously important. However, to some extent, it is also true that you will get what you actually pay for. Always remember that the cheapest brokers are not the best all the time. It might be worth paying something extra in case you feel that a bit expensive broker will fit better with all your needs. One basic reason for paying a bit more is if you are starting new and want some help. The majority of online brokers are referred to as discount brokers as they tend to keep all their commissions low, and the only service provided by them is to transact the orders that you want to. You will also get full-service brokers, which will surely charge you more. However, you will get the benefit of some experienced professionals who will offer you expert guidance and advice. Opting for a full-service broker is always suggested, as you can easily switch back to a discount broker after you gain all the necessary confidence and experience for going all alone. Quality and speed of order execution. The speed at which a broker can properly execute all your orders is another important factor that you should keep in mind. In case your broker fails to carry out transactions in a timely manner, it might lead to a negative effect on the way your orders get filled. In fact, it might result in the orders not getting filled. The best brokers will try to execute all your orders right on time, as quickly as possible. They will also be able to make sure that they get transacted at the best price. Having the best prices available can lead to a major difference to the bottom line. So, it is something that you will have to take care of. Also, you will need a broker that comes with a responsive and fast site, as the market of options tend to move quite quickly. In case the site or platform of your broker is updating slowly or having some kind of delay in trying to move from one page to the other, then it might result in reduced gains, missed chances, or even great losses in case you are trying to place some order. Although it is not related to choosing an ideal broker, it is the perfect time to mention they need to have the latest technology. You will need to have some of the modern types of equipment along with a good internet connection if you are willing to trade options online. Platform of trading and ease of use. Options trading is complicated enough already without the extra complexities of using a broker that comes with a platform of trading that is tough to use. The last thing that you might want to do is to spend a great deal of time figuring out all the information that you are searching for, or the need to go through an extensive process while placing your orders. You would definitely want a broker that comes with a friendly interface, a simple procedure of ordering, and several other features that will help with the overall functionality. Security measures. In case you have opened an account with any online broker and you have got your money with them, you will surely want to be confident that your overall account is safe and secure and comes with all the required facilities that can prevent hacking. Unfortunately, hacking is a modern-day problem that comes along with the usage of online technologies for making financial transactions. The top brokers put into use the best and the latest security measures that can ensure that your account is protected from all sorts of external interference. The best brokers will make sure that any form of private details along with your account is safe all the time. Customer support. Although you would want everything to proceed smoothly all the time, there are chances when you might have to face some sort of technical issues or difficulties at some point or the other. That is the main reason why the kind and level of customer support that a broker provides is also an essential factor that you will need to consider while choosing a broker for making your trades. It will always be nice to know that you have got yourself covered with nice customer support all the time in case any problems arise. Reputation. The top brokers will typically build up a great reputation base for themselves and will also come with superb track records of giving proper quality service to all their customers. If you try to opt for and stick to all those brokers that come with good reputations overall, the chances are high that you enjoy positive experiences all the time. Right before you open an account with any online broker, it will be better for you if you can do some research and find out if there is any form of negative feedback regarding them anywhere on the internet. Also, you will have to ensure that you sign up only with those brokers that are recommended by trustable and reputable sources. Additional things to consider. The factors that we have discussed until now are surely the most important ones. However, there are certain other considerations that will be worth taking into your consideration. For instance, the trading plan that you have developed might be completely based on the trading of options. However, there might be certain odd occasions when you would like to diversify your portfolio and invest in some other financial instruments as well. In case you think you have probable chances of doing so, then you might have to look out for brokers that provide selling and buying of other financial instruments as well. You might also have thoughts regarding the alternatives that are available in case you are not able to make online trades. If you want to make some trade but do not have internet access, you would like to have an alternate way of placing all your orders. In case you feel this might be an issue for you, try to consider all those brokers that provide customers with several other ways of making trades and also communicate. There are also certain considerations related to finances. Something that might turn out to be of great relevance for beginner traders is the minimum deposit amount that is needed. There are several online brokers that require a high percentage of deposit amounts. In case you are thinking of starting with a small capital amount, then it might turn out to be a problem for you. Before you decide to sign up anywhere, Make sure you check out the minimum deposit amount that is needed and also ensure that the same fits within your set budget. Some other considerations related to finances are the nature of incentives that might be available. As there are a huge number of online brokers available today, the entire marketplace has turned out to be very competitive, and the brokers are always trying to introduce new perks for attracting more customers. One of the ways in which this is done is by providing incentives to the traders for signing up. Such forms of incentives might include free or reduced commissions for a certain time period, or the addition of some free funds for the first deposit. A little bit of extra money is not enough all the time to opt for a certain broker unless and until they tend to meet all your other necessities. However, in case you are struggling to decide between two probable brokers, then opting for the one that offers the best sign-up offer is a great way to decide. But beware, as all such incentives often come with some terms and conditions. So, you will need to be aware of the commitments that you will have to make. The last factor that you will have to consider is the levels of trading that are available in front of you. Whether this is relevant to you depends on the way you plan to use your options contracts. In case your plan is to use options as a hedging strategy to provide protection to some existing portfolio, trading levels won't be of much relevance to you. The majority of online brokers will permit you to sell call options or purchase put options on underlying assets that you own already, as you are not taking any form of additional risk. All that you are doing is hedging against all your securities from falling in value. But if your plan is to use options without owning any relevant underlying asset, then the levels of trading might turn out to be an issue for you. If your plan is to purchase options with the idea of selling them for gaining some profit, the majority of online brokers will permit you to do that, provided that you have got enough funds for doing so. In case you are putting into use all those strategies that involve selling options, and therefore the margin of options, then you will need to consider trading levels. As you sign up for any options broker, they will opt for some risk assessment in order to find out the risk level that is suitable for you. After that, your account will be assigned a certain level of trading. All of this will stipulate the perfect level of options margin and will also affect the strategies that you can use to some extent. So, if your plan is to put into use some of the complex strategies that need options margin, you will have to look out for the requirements of the online brokers for being assigned with the level of trading that you require. Chapter 7: Brokers and Platforms. Options trading gained a considerable amount of traction in the past few years, especially with retail investors. The beginner investors and the active traders can now trade options with full confidence, all because of the tools of risk management analysis that are offered by the majority of brokers. We will discuss some of the best options trading platforms and brokers that are available today for making your journey of options trading much smoother in this section. Interactive brokers. Interactive brokers can be considered as one of the best options trading platforms that are available today. It offers investors a wide range of easy-to-use and smart tools. Although the platform initially catered only to the active traders, they now also offer trading services for the new traders and the ones with less experience. The platform offers a $0 account minimum along with no per-leg fee. In fact, you can get the lowest margin rates besides a comprehensive selection of lessons related to options. But the customer service is not that great in comparison to other platforms. The platform provides an application for the traders besides their online site. The platform can be customized according to one's preference and is also user-friendly. The Option Trader feature shows real-time market data and also permits users to create and implement complex strategies in no time at all. But someone with less than $100,000 in assets in their account will have to pay fees of $10 every month besides being charged various other fees for receiving real-time data. The platform provides an iBot feature for the new traders that provide the needed help and simple answers. You can ask your queries, and iBot will provide you with the needed reply. Also, the platform of Interactive Brokers provides investors with the ability to set up a spread in very little time, and then move the same to a future date of expiration within a few clicks. You can opt for this platform if you are looking out for a great application, smart tools, and comprehensive learning materials. Robinhood. Robinhood is a new platform that completely changed the game with its no commission approach to ETFs, options trades, and stocks. Also, there is no requirement of maintaining an account minimum for signing up. It offers investors a streamlined mobile application and is a great choice for all those investors who want only certain options. It offers low cost and easy margin trading, but it lacks online tools and educational resources. Robinhood is preferred by investors for its seamless access to both options and stocks. It helps in simplifying options by making them quite easy to execute. It will show you how much you might lose or gain by a certain date relying on the value of the underlying stock. With low margin trades and no form of fees, you will get the chance of saving a great amount of money when it is about the trading of options. But you won't be able to take the help of any kind of portfolio testing tools or spread intelligence tools. All that you can do is just use the mobile application, make all your trades, and keep a check on your portfolio. The platform offers minimalist features that can be a great option for new traders. Ally Invest. Ally Invest comes with a low-cost brokerage. One of the best things about Ally Invest is that there is no need to maintain an account minimum. The platform gets support from Ally Financial. Investors can enjoy a universal experience regarding their account management. In fact, the platform website is very easy to use. In case you are new to the world of options trading, this trading platform might turn out to be a superb choice for you. The platform is well known for its excellent customer service. There is no need for any huge investment, and you can even start with a very small amount. You can dedicate all your time to learn how to trade as the involved risk factor is quite low. Traders can easily modify the settings according to their use, check out necessary charts, and also opt for technical analysis without any extra effort. The platform is very clean, and any new trader can understand the basics within no time at all. TD Ameritrade. Are you a beginner in the world of options? Then you can easily start with your trading life with the easy-to-use website and application of TD Ameritrade. It comes with a great deal of educational content and tools that make trading options an easy task. It offers free per-leg trading of options with charges of only about 65 cents for every option contract. If you are an advanced trader, you can enjoy the facilities of the new tools and research options for the trading of options. You can seamlessly choose from hundreds of options and have a look at the tools of risk management. For new traders, the platform provides access to educational tools in order to properly understand complex spreads. Also, the platform comes with a charting feature which is much advanced in comparison to other platforms. eTrade. If you are willing to start with options trading, the platform of eTrade offers some of the best spread options and research tools. The price of options is 50 cents to 60 cents per contract. That depends on how much you trade. The platform offers extensive access to some great strategies of options chains that are different from the ones that can be found on other platforms. eTrade permits investors to work on much complex spreads along with customized options. For instance, you can easily set up a strategy of an iron condor and also define the option spread's strike width. The data that is relevant for your option spread will only be streamed for you. You can also find a performance risk tool that will show you the risks on any of your holdings. You can find out what it says about the overall portfolio as well. Technical Insights is one of the best features of eTrade that provides you access to all sorts of analytical charts and also showcases the way your spreads might perform in the coming days. Chapter 8. Basics of Technical Analysis. There are two proper things that can very easily affect the process of decision making of traders: greed and fear. The best possible way of determining the choice and also to keep track of the same is the usage of charts. You are not needed to hold some great degree for understanding the overall process of technical analysis or the process of assessment of charts. Technical analysis is often regarded as one of the most important tools in the options trading world. The longevity and health of any concerned company are required to be determined by the use of fundamentals and books and not with the help of technical analysis. The regular stock movements will also not be altering any of the related fundamentals. In fact, a company won't be altering its fundamentals on a daily basis. So, what is the reason behind constant alterations of stocks regularly? The answer to this question can be easily provided by using only one word: emotion. Emotions play a great role in driving short-term fluctuations in the price. Whenever a trader feels good regarding a stock price, they tend to buy that stock. When they do not feel okay with the stock price, they just sell it out. Technical analysis is essential for projecting some minutes or months out. In case the out tends to go beyond the mark of 4 months, the analysis is considered to be of no use. Technical analysis cannot be used for determining the reports in regards to any company's earning. The company and market are not at all concerned with what gets depicted by the charts regarding what will happen in the future. Most options traders are short-term, so you can easily find out the reason behind the craze of weekly options and also why there is a steady call for regular options. Standard options cannot just depend on fundamental analysis. It is primarily because they might not last long, and that matters to a great extent. So, all that traders can do is rely on technical analysis. Technical analysis indicators. No matter which broker you opt for, they will ask you to put into use a definite set of indicators. Regardless of the number of indicators you combine at one time, you can never have the perfect indicator set that will provide you the perfect time for buying and selling. We will discuss some of the most common technical analysis indicators in this section. RSI, or Relative Strength Index. The RSI is an indicator of momentum that helps in comparing the magnitude of the latest gains to the latest losses over a certain time period in order to measure the speed of the security and also change in price movements to determine oversold and overbought conditions. The values of RSI range from 0 to 100. A value above the mark of 70 is considered to be an indicator of overbought levels, and an RSI value below the mark of 30 is an indicator of oversold levels. RSI tends to work the best for options on the individual stocks, in comparison to indexes, as stocks can demonstrate oversold and overbought conditions more frequently and easily than indexes. Bollinger Bands. Every trader of options is well aware of volatility and its importance. Bollinger Bands are one of the best ways to measure volatility. The bands tend to extend as the volatility increases and tend to contract when the volatility decreases. The closer the overall price gets to the upper band, the more overbought will be the security, and the closer the overall price gets to the lower band, the more oversold the security might be. Any movement of the price outside the bands indicates that the security is ripe enough for reversal, and traders of options can easily position themselves according to the same. For example, a breakout right above the top band might indicate a chance to use a short call or long put position. On the other hand, a breakout that is below the lower band might represent an opportunity to initiate a short put or long call strategy. Also, remember that it always makes sense to sell out options during periods of high volatility when the prices of options are in an elevated position. Opt for purchasing options during periods of low volatility when the prices of options are relatively lower. IMI, or Intraday Momentum Index. It acts as a great technical indicator for all the high-frequency traders of options who are looking out for betting on intraday movements. It sums up the concepts of RSI and intraday candlesticks, thus providing a proper range for intraday trading simply by indicating oversold and overbought levels. With the use of IMI, a trader of options can easily spot the potential opportunities for initiating a bullish trade in a market that is uptrending at an intraday correction, or start a bearish trade in a market that is downtrending at a price bump of intraday. MFI, or Money Flow Index. MFI acts as an indicator of momentum that combines volume data and price. It is often called volume-weighted RSI. The MFI indicator helps in measuring the outflow and inflow of money into any asset over a certain period and acts as an indicator of trading pressure. Getting a reading over the mark of 80 is an indicator that the security is overbought, and a reading below the mark of 20 indicates that the security is in an oversold condition. As it depends on volume data, MFI is always better suited for stock-based trading of options and for trades of longer duration. When the MFI tends to move in the exact opposite direction of the stock price, it can act as a leading indicator of a trend change. PCR, or Put-Call Ratio Indicator. It helps in measuring trading volume using put options in opposition to call options. In place of the absolute value of the ratio of put-call, the changes in values indicate some sort of change in the overall market sentiment. When the number of puts is more than that of the calls, the ratio is above the mark of I, thus indicating bearishness. When the volume of calls is more than the volume of puts, the ratio is below the mark of I, thus indicating bullishness. But traders often view the ratio of put-call as a contrarian indicator. OI, or open interest. It indicates the unsettled or open contracts in options. It does not indicate a particular downtrend or uptrend. However, it provides indications regarding the strength of a specific trend. Increasing OI is an indicator of the inflow of new capital and, thus, the sustainability of an existing trend. Declining open interest indicates a weakening trend. Chapter 9. Having control over emotions. There are several skills that a trader needs to master for successfully trading in the markets of finances. They also involve the ability to evaluate the fundamentals of a company and also to determine the stock trend direction. However, neither of the technical skills is as essential as the mindset of the trader. Quick thinking, having control over emotions, and exercising discipline are the components that are collectively termed trading psychology. There are two primary emotions that you will have to understand and also keep under your control: greed and fear. Snap decisions. Traders are often needed to think fast and opt for making quick decisions, darting in and out of the stocks on very short notice. In order to properly accomplish this, you will need a proper presence of mind. You will also need to be disciplined for sticking to your own plans of trading and know when to book losses and profits. Emotions can never get in the way of proper trading plans and execution. Understanding fear. Whenever a trader gets some sort of bad news regarding a specific stock or about the overall economy, they tend to get scared naturally. They might overreact and also feel compelled to liquidate all their holdings and just sit peacefully on the cash. They might refrain from opting for any further risks. In case they do so, they might be able to avoid some potential losses. However, they might also miss out on the chance to make some gains. Successful traders need to properly understand what fear actually is: a natural reaction to any form of perceived threat. In the case of trading, it is a threat to profit potential. Quantification of fear might help a lot. Traders need to consider what they are actually scared of and also the reason why they are scared of the same. However, this sort of thinking needs to occur much before the bad news and not in the middle of the same. By thinking the reasons ahead of time, traders can easily determine the way they perceive various events instinctively and also react to them and can move ahead of the emotional response. Indeed, it is not that easy. However, it is essential for the health of your portfolio. Dealing with greed. You must have heard an old saying on Wall Street: pigs get slaughtered. It indicates the greedy nature of investors that they have for sticking to a good position for a long time in order to get everything upward in price. Very soon, the trend tends to get reversed, and the greedy investor gets caught in the trap. Greed is not at all an easy thing to overcome. It is most often structured on the instinct of doing better, for getting a bit more. You will have to learn how to recognize all such instincts and also develop a plan of trade that is built of rational thinking without any form of instincts or whims. Setting up rules. A successful trader has to create rules and also follow them when any form of psychological crunch develops. You will have to set proper guidelines depending on your risk-reward tolerance for when you should enter any trade and when to exit from the same. Try to set up a profit target and also put a stop loss in the proper place for taking your emotions out of the process. Additionally, you will have to make up your mind which nature of events, like negative or positive earnings release, should trigger any of your decisions for selling or purchasing a stock. It will be wise of you to set up limits on the maximum amount that you can lose or win in one day. In case you reach the profit target, opt for taking out the money and just run. If you reach your limit of losses, just fold up the tent and get back home. With both, you will get the chance to live for trading on some other day. In case you try to go beyond the set limits, the chances are high that you might lose everything that you currently have, with no chances left for future trading. Always keep in mind that trading is a very risky affair. You will have to properly identify your limits for getting the best out of it. Opting for review and research. As a successful trader, you will have to be an expert in the industries and stocks that you find interest in. Try to be on equal footing with the latest news, opt for education, and if you can, opt for trading conferences and attend seminars. If you are determined to be a successful trader, you will need to devote the majority of your time to the process of research. That involves speaking up with the management, studying charts, opting for trade journals, and doing several other background stuff like industry analysis or macroeconomic analysis. Enough knowledge can provide you with the needed support for overcoming fear. Being flexible. It is an essential thing for traders to be flexible and also to consider experimentation from time to time. For instance, you might regard using options for mitigating all forms of risks. One of the best possible ways in which a trader can learn new things is by experimenting, obviously within boundaries and reasons. Gaining experience can help a lot in reducing all sorts of emotional influences. For being a successful trader, you need to assess your own performances periodically. Along with reviewing all your returns and positions, you need to reflect on the ways in which you are prepared for a session of trading, how updated you are on the markets, and the way you are progressing in regards to ongoing education. Such nature of periodic assessment can provide you with the needed help to correct any of your mistakes, change all your bad habits, and also improve your overall returns. Chapter 10. Risk Management. Correct management of risk exposure and capital is important for options trading. Although risk is something that is unavoidable with any investment form, your risk exposure is not required to be a major complication. The main key here is to manage all the risk funds in an effective way. You will have to make sure that you are completely okay with the level of risk that you are going to take. Also, you will have to ensure that you are not putting yourself forward for experiencing certain unsuitable losses. Well, this concept can also be put into use for money management as well. You must always be trading with the use of funding that you are actually capable of losing and try to stay away from overextending your limits. As proper management of capital and effective risk is quite crucial for the successful trading of options, it is something that you have to understand truly. We will discuss some of the ways in which you can manage your exposure to risk and also control the overall budget. Opting for trade plans. It is quite essential to possess a detailed plan of trade that properly lays out all the guidelines along with the parameters for your activities of trading. One of the most functional uses of all such plans is the provision of help in the management of your money besides risk exposure. The plan needs to have all the details regarding the risk level that you feel comfortable with, along with the capital amount that you are willing to use. Simply by abiding by your plan of trading and putting into the use money fixated for options trading, you can easily prevent yourself from opting for one of the mistakes that most traders tend to opt for: putting into use scared money. As you try to trade with the capital that you can't afford to waste or must have allocated for something else, you won't be able to make any form of decisions of rational nature in all the trades. Although it is quite tough to totally discard all kinds of emotions that are related to options trading, you have to be focused as much as you can on everything that you are doing and why. Using options spreads. These are essential and strong tools in the field of options. It is when you try to add more than one single position on the contracts of options that are established on a similar asset for the effective creation of a trading position. For instance, when a trader purchases call options that are in the money on a certain stock followed by selling out of cheaper out-of-the-money calls on a similar stock, then you will create a bull-call spread, which we have already discussed in the earlier chapters. All strategies of trading of options contracts include the usage of spreads. All such spreads serve as a useful way of managing risks. They can be used for the reduction of upfront costs to enter a position and also to minimize the amount of money that you might lose. It indicates that you might reduce the potential profits. However, it will also reduce the overall risk. Opting for diversification. It is a technique of managing risk that is put into use by traders who are developing a stock portfolio with the strategy of buying and holding. The primary principle of diversification is that spreading the investments over various sectors and companies helps in the creation of a balanced portfolio instead of having an excessive amount of money stuck in one single sector or company. A diversified portfolio is regarded to be much less disclosed to overall risk in comparison to all such portfolios that consist of only one form of investment. When it is about contracts of options, opting for diversification is not that essential in the exact same way. But still, it has its uses, and you, as an investor, can easily opt for diversification in a variety of ways. The principle is the same. You would not want a great amount of your funding to be stuck in one type of investment. You can opt for diversification in options trading by opting for a collection of certain approaches and by opting for contracts that are established on various types of underlying assets. It can also be done by opting for options of various types. The main idea behind diversifying your portfolio is that you can earn profits in different ways. You will not need to be reliant completely on a single type of outcome for having successful trades. Opting for options orders. Another great method of managing risks is by utilizing various order types that can be placed. Along with the 4 types of orders that can be used for opening and closing positions, there are several other types of orders that can be placed by you, and a majority of them can help in the management of risk. For instance, a general market order gets filled at the highest price during execution. It is a natural method of selling and purchasing contracts of options. However, in a highly volatile market, the order might get filled at an amount that is lower or higher than required. You can easily prevent selling or purchasing at lesser agreeable rates by using limit orders as the maximum and minimum prices at which the order might get filled can be set. In fact, you will come across orders that can be used for automating the exiting of a position, no matter if it is for locking in the already made profit or for cutting the losses on any trade that failed to properly work out. With the use of orders, like trailing stop order, market stop order, or limit stop order, you can properly manage the point at which you would like to get out of any position. Conclusion. Thank you for making it through to the end of the option trading crash course. Let's hope it was very filled with useful information and was also able to provide you with all the needed tools that you need to attain your goals, whatever they may be. As you are now aware of the basics of options, all that you require to do now is get yourself ready and enter the marathon of options trading. We have already discussed that trading is not a complex thing. All that you need is a presence of mind and a bit of knowledge about options for being successful in the world of options. The game of options trading will be too easy or too rough for you, relying on the way you try to opt for the same. Options trading comes with a wide range of tools besides strategies that makes the whole thing a lot easier for the new traders. It does not really matter whether you are an active trader or are just a newbie in the world of trading. Options trading has got something in store for all. Try to opt for the perfect strategies on time, and you can easily see profits in no time at all. Try to attain as much knowledge as you can from anywhere possible, and it is the only thing that will help you in moving ahead. Just keep in mind all that you have learned in this book, and you will soon be able to generate profits properly.